Welcome back to the Deep Dive, everybody. Today, we're going to be tackling a topic that might make some eyes glaze over at first, but stick with me, folks. It's cost accounting.
Yeah, it might not sound like the most thrilling subject.
Right. But honestly, if you're in business, any kind of business, and you want to really understand where your money's going, and more importantly, how to make more of it, this is absolutely crucial stuff. We've been digging into cost accounting for dummies. And let me tell you, there's some real gold in there.
There is. And that's what we're going to do in this deep dive. We're going to pull out those key insights, those core concepts, and really, kind of demystify them.
Yeah, and we're going to do it in a way that makes it, well, as painless and as clear as possible. So you can actually take this information and use it to make a difference in your business.
Exactly. Because at the end of the day, that's what matters, right? You're in business to make money,
Yeah.
and understanding your costs is absolutely essential to achieving that.
All right, so let's start with the basics. What exactly is cost accounting?
So, in a nutshell, cost accounting is all about analyzing and planning the costs involved in producing whatever it is you sell, whether it's a product or a service,
Okay.
and the ultimate goal,
What is it?
to reduce or eliminate those costs and, you guessed it, increase your profits.
So it's not just about, tracking expenses. It's about strategically managing them.
Precisely. It's about making informed decisions that will lead to a healthier bottom line. Now, here's where it gets really interesting. Cost accounting plays a crucial role in determining whether your pricing is actually working.
Okay, how so?
It helps you answer that fundamental question. Is the revenue you're bringing in from selling your product or service truly covering all the associated costs and, importantly, generating a profit?
Right, because you might think you're making money on something, but if you're not accounting for all the costs involved, you could be in for a rude awakening.
Exactly. Now, you mentioned different types of accounting, so let's clarify how cost accounting fits in with financial and management accounting.
Yeah, that would be helpful.
So, financial accounting is all about reporting on the past. It's focused on creating those formal financial statements, balance sheet, income statement, statement of cash flows for external stakeholders like investors and creditors.
Yeah.
Management accounting, on the other hand, is much more internally focused. It's about providing information to managers to help them make better decisions. It's a bit more flexible and can tailor reports to specific needs within the company.
And where does cost accounting fall in all of this?
Cost accounting kind of bridges the gap between the two. While it utilizes historical data, it's very much forward-looking in its focus on planning, controlling, and reducing costs.
So in essence, it takes that financial information and turns it into actionable insights for managers.
Exactly. And another key area where cost accounting comes into play is budgeting.
Budgeting, of course. That's essential for any business.
It is, and it goes beyond just forecasting sales and expenses. Budgeting, through the lens of cost accounting, is about strategically planning how you're going to use all your resources, your cash, your equipment, your people, to achieve your financial goals.
Okay, that makes sense. Now, let's dig a little deeper into the different types of costs businesses have to deal with. We have direct costs and indirect costs.
Right.
What's the key difference there?
So direct costs, as the name suggests, are costs that can be directly traced to a specific product or service. Think raw materials, direct labor.
Okay, give me an example.
Sure. Let's say you're a furniture maker and you're building chairs. The wood, the fabric for the upholstery, the screws, those are your direct material costs.
Okay.
And the wages of the craftsman who's actually putting those chairs together, that would be your direct labor costs.
Okay, so that's pretty straightforward. Then what are indirect costs?
Indirect costs, or overhead, are a little trickier. These are costs that can't be directly linked to a specific product or service, but are still necessary for the overall operation. Things like rent for your factory, utilities, salaries of administrative staff, insurance for the company vehicles. You can't pinpoint exactly how much of those costs go into each chair you make.
Right, so you can't just slap them on the price tag of one chair. What do you do with them then?
Well, you have to allocate them, spread them out over your products or services in a way that makes sense. And that's where things can get a little, well, debatable.
Yeah, because how do you decide how much of the rent, for example, goes into each chair?
Right. There are different methods for allocating indirect costs, and choosing the right one can have a big impact on your cost calculations and ultimately your profitability.
So you really need to choose an allocation method that accurately reflects how those indirect costs are actually being used to support your various products or services.
Exactly. And this is where a deeper understanding of your business processes and cost drivers is essential.
Okay, so we've got the basics of direct and indirect costs. Now let's talk about job costing. This seems relevant to businesses that do very specific, customized work.
Absolutely. Job costing is perfect for situations where you have unique projects or jobs, each with its own distinct set of costs.
Give me some examples.
Think custom home builders, construction companies, catering services, even law firms handling individual cases.
Mhm.
Each project is different, requires different materials and labor, and takes varying amounts of time to complete.
So how do they go about figuring out the cost of each job?
Well, it starts with tracking those direct costs, the materials and labor that go directly into that specific job.
Okay.
And then they'll allocate a portion of their overhead costs to each job as well, using a predetermined overhead rate. This helps them determine the total cost of the job, which is crucial for pricing, billing, and of course, profit analysis.
Okay, so they're basically building up the cost of each job from the ground up, tracking all the individual pieces.
Precisely. Now, in job costing, there's this concept of a cost driver.
Okay, a cost driver, what's that?
A cost driver is basically the factor that causes a particular cost to go up or down. For example, if you're a printing company, the number of pages printed could be a cost driver for your ink costs. The more pages you print, the more ink you use, the higher your ink costs. Makes sense, right?
It does.
And then you have the cost object, which is basically whatever you're trying to determine the cost of. So for the printing company, each individual print job would be a cost object.
Got it. So if we were to break down a job like building a fence for, let's say, the Johnsons, how would we figure out the direct costs?
All right, so for the Johnson's fence, you'd first look at all the materials that went directly into building it.
Okay.
The lumber, the concrete for the posts, the fasteners, any gates or hardware.
Okay, and
And then you'd calculate the total cost of each material.
so how would you do that?
Pretty straightforward. You take the quantity of each material used and multiply it by its unit price.
All right, makes sense. What about the labor costs?
For labor, you'd track the hours spent by the workers specifically on the Johnson's fence. You'd multiply those hours by their hourly wage, and bam, you've got your direct labor cost for that job.
Got it. Now, how do those indirect costs, the overhead, get factored in?
Well, you'd use that predetermined overhead rate we talked about.
Yeah.
So let's say your overhead rate is based on direct labor hours,
Okay.
and you've determined that it costs you $20 in overhead for every hour of direct labor.
Yeah.
If the Johnson's fence took 20 hours of direct labor, you'd allocate $400 in overhead to that job.
Makes sense.
Yeah.
But how do you actually come up with that overhead rate in the first place?
Good question. It involves some estimating and forecasting. Let's say, for example, you're a landscaping company, and you estimate that your total overhead costs for the year will be, let's say, $50,000.
Okay.
And you also estimate that your crews will work a total of 10,000 direct labor hours during the year.
Okay.
To get your overhead rate, you divide that total overhead cost, $50,000, by the total direct labor hours, 10,000, which gives you an overhead rate of $5 per direct labor hour. So for every hour your crews spend working on a client's yard, you'd allocate $5 of overhead to that job.
Got it. So it's really all about finding a logical way to connect those overhead costs
Yeah.
to the work that's being done.
Exactly. Now, there's also this idea of normal costing.
Okay, normal costing. What's that all about?
So normal costing is a way to estimate the total cost of a job before it's even finished.
Okay.
It's kind of like a preliminary costing. You use your budgeted overhead rate instead of waiting until the job is done and then calculating the actual overhead costs.
Okay, so that can be helpful for things like giving clients estimates or making decisions about which jobs to take on.
Absolutely. It gives you a good starting point. Now, even though job costing focuses on distinct projects, we still have those inventory terms like work in process, finished goods, and cost of goods sold.
Right, I was wondering how those fit into the picture.
So think of it this way. Work in process represents the accumulated costs of those jobs that are in progress. They've been started but haven't been completed yet. So as you're incurring those direct material, direct labor, and overhead costs on a particular job, the balance in your work in process account for that job keeps growing.
Okay.
Once the job is finished, all those costs get transferred out of work in process and essentially become finished goods in the sense that the job is done, ready to be billed to the client.
Okay.
And finally, when the client pays for the completed job, that cost moves into your cost of goods sold, which is an expense account on your income statement.
Okay.
So it's really just a way of tracking the costs from the initial stages all the way through to when you finally recognize the revenue from that job.
All right, that makes sense. Now, let's move on to a slightly more complex topic.
Yeah.
Activity-based costing, or ABC.
Ah, yes, ABC.
This seems like a more sophisticated way to deal with those indirect costs, those overhead costs that we were just talking about.
It is. It's a more refined approach that recognizes that not all overhead costs are created equal.
Okay, explain that.
So, with traditional costing methods, you often use a single overhead rate to allocate those indirect costs.
Right.
But the problem is that this can lead to distortions. It can make some products look more profitable than they actually are, and others look less profitable.
Okay, how so?
Well, imagine you have a factory that produces two types of products, a simple one and a complex one. The simple one requires very little machine setup and quality inspection, while the complex one requires a lot.
Okay.
If you're using a single overhead rate based on, let's say, machine hours, then that simple product is going to be burdened with a portion of those setup and inspection costs, even though it doesn't actually use those resources as much.
So it's like those costs are being unfairly spread around.
Exactly. And that can lead to some pretty misleading conclusions about the profitability of each product.
Okay, so how does ABC address this?
ABC identifies specific activities within the business that drive those overhead costs. Things like machine setups, quality inspections, material handling, product design. Each of these activities consumes resources and incurs costs.
Okay.
Then you assign those costs to cost pools, basically buckets for each activity.
Got it.
And finally, you allocate those costs to the products or services based on how much of each activity they actually use.
So if a product requires a lot of machine setups, it's going to absorb a larger portion of those setup costs.
Exactly.
If it requires very little inspection, it's not going to get hit as hard with those inspection costs.
Precisely.
So it's all about matching the cost more accurately to the things that are driving those costs.
That's it. Now let's go back to that windshield manufacturer we talked about earlier. They're making windshields for both sedans and vans.
Okay.
Now, if they use a simple overhead rate based on just production volume, they might end up allocating the same amount of overhead to a sedan windshield and a van windshield, even though those van windshields are much larger and more complex to produce. Right. ABC would say, hold on a second, let's look at the specific activities involved in making each type of windshield.
Okay.
Molding setup, machine processing, inspection, packaging, installation. All of these activities probably take more time and resources for the van windshield.
So ABC would allocate more of those costs to the van windshield, reflecting the fact that it's actually using up more resources.
Exactly. It's all about being more precise and realistic in how you assign those indirect costs. Now, it's important to note that even with ABC, some cost allocations might end up being the same across different products.
Okay.
And that's fine, as long as the underlying activity levels are actually similar. The goal isn't to create an endless number of cost pools, but to really pinpoint those key activities that are driving the bulk of your overhead costs.
Got it. So it's all about using your best judgment and making sure the allocation method you choose is actually reflecting the reality of your business operations.
Precisely. Now, we talked about a flower bed and lawn care company earlier, and you might be wondering how ABC applies to a service business like that.
Yeah, that's a good point. How does it work in that scenario?
Well, it's the same basic principle. You identify the key activities involved in providing both the flower bed installations and the lawn care services.
Okay.
Things like, meeting with clients, preparing quotes, sourcing materials for the flower beds, transporting those materials and equipment to the job sites, the actual labor involved in installing the flower beds or mowing the lawns, and any follow-up service calls.
Right.
Then you set up a cost pool for each of those activities and identify a relevant cost driver.
Okay. Give me an example.
Sure. Let's say the cost of preparing quotes is driven by the number of quotes you prepare, right?
Yeah.
So the more quotes you send out, the more time and resources you're using for that activity, and the higher your cost will be.
Okay, that makes sense.
And then your transportation costs might be driven by the distance traveled or the number of trips. So for each service, you'd allocate the costs from those cost pools based on how much of each activity that service actually used. And then, of course, you'd add on those direct costs like the flowers themselves or the lawn care workers' wages.
So it's a way to get a more accurate picture of the profitability of each service, taking into account all the supporting activities that go into delivering that service.
Exactly. Now let's shift gears and talk about budgeting. We touched on it earlier, but I think it's worth diving a little deeper into how cost accounting principles play into effective budgeting.
Yeah, budgeting is essential. You can't really run a business without a plan, can you?
Definitely not.
Yeah.
A budget is more than just a set of financial projections. It's a roadmap, a guide for making informed decisions about how you're going to allocate your resources to achieve your financial goals.
And the master budget is kind of like the The big picture, right? The overall plan for the whole company.
Exactly. It brings together all the different departmental or functional budgets, like your sales budget, your production budget, your marketing budget, and so on.
So it's a way to make sure everyone's on the same page and working towards the same goals.
Exactly. Now, the budgeting process can be a bit overwhelming. There's so much data available these days. It's easy to get bogged down in the details and lose sight of the big picture.
Yeah, I can see that happening. So how do you avoid getting lost in the numbers?
You need to focus on those key performance indicators, KPIs. These are the metrics that really matter, the ones that drive your business. For example, if you're a retailer, you might focus on metrics like sales per square foot or inventory turnover.
Okay, so how do those KPIs inform your budget?
Well, you need to set realistic targets for those KPIs, and then you need to allocate your resources in a way that supports achieving those targets. So, for example, if you want to improve your inventory turnover, you might need to invest in better inventory management systems or streamline your ordering process.
Makes sense. Now, with all this data available, do you think technology can play a role in making the budgeting process more efficient?
Absolutely. We have access to some incredibly powerful tools these days that can help us analyze data, identify trends, and make more informed decisions.
Okay, give me some examples.
Think artificial intelligence, machine learning. These technologies can help us uncover patterns in our data that we might not even be aware of, which can be invaluable for forecasting and planning.
Okay, so it's not just about crunching the numbers, it's about using technology to gain insights and make smarter decisions.
Exactly. And another key aspect of budgeting is aligning employee compensation and incentives with your budget goals.
Okay, explain that.
If you want your employees to be invested in achieving your budget, they need to understand how their work contributes to those goals and how their performance will be rewarded. It's all about creating that sense of ownership and accountability.
Okay, so it's not just a top-down process.
Mm.
You need to involve your employees and get them on board with the plan.
Exactly.
Yeah.
Now let's get into some specific budget calculations. First up, the production budget. This one tells you how much product you actually need to produce to meet your sales forecasts while also maintaining your desired level of ending inventory.
Okay, walk me through the math.
Sure, it's pretty straightforward. Your desired ending inventory is equal to your beginning inventory plus your production minus your sales. So if you know how many units you want to have on hand at the end of the period, how many you have at the beginning, and how many you expect to sell, you can rearrange that formula to figure out how many units you need to produce.
Okay, so it's like a balancing act. You need to make enough to cover your sales, but you also need to make sure you have enough left over to meet your inventory goal.
Exactly. Now, another important budget is the cash budget. This one forecasts your cash inflows and outflows over a specific period, usually a month or a quarter. It helps you make sure you have enough cash on hand to cover your expenses and avoid any nasty surprises. For example, if you're a seasonal business, you might need to build up your cash reserves during your busy season to cover your expenses during the slower months.
Right, because you don't want to run out of cash when you need it most.
Precisely. Now, in budgeting, we often talk about the matching principle.
Matching principle. We touched on that earlier, didn't we?
We did.
So how does it apply to budgeting?
So the matching principle basically says that you want to try to align the revenues you expect to earn in a period with the expenses that are directly related to generating those revenues.
Okay.
So for example, if you're a retailer and you run a big advertising campaign in December to boost your holiday sales, you would match the cost of that advertising campaign with the December sales revenue, even if you don't actually pay for the advertising until January.
Right, so it was all about matching up those costs and revenues in the same period, so you get a clearer picture of the profitability of that particular activity or campaign.
Exactly. Now, let's be realistic. Things don't always go according to plan.
Yeah, that's for sure.
So what happens when your actual results deviate from your budget? Well, that's where management by exception comes in.
Management by exception.
No, it's basically a way of prioritizing your time and attention. Instead of sweating over every little difference between your actual results and your budget, you focus on those major variances, the ones that could really impact your business.
Okay, give me an example.
Sure. Let's say your budgeted cost for raw materials was $10 per unit, but your actual cost turned out to be $15 per unit.
Okay, that's a big difference.
Yeah, that's a significant variance that you'd want to investigate and try to understand why it happened. Was there a price increase you didn't anticipate? Did you have more waste than you expected? Or were there some inefficiencies in your production process? By focusing on those big variances, you can identify areas where you need to make adjustments and course corrections.
Okay, that makes sense. Now, what about flexible budgets? How are those different from regular budgets?
So, a flexible budget is basically a budget that adjusts based on your actual level of activity.
Okay.
So, it recognizes that your costs and revenues aren't always going to behave exactly as you planned, and it allows you to compare your actual results to what you would have expected given your actual output.
Okay, can you illustrate that with an example?
Sure. Imagine you're a manufacturer and you budgeted to produce 10,000 units, but you only ended up producing 8,000 units.
Okay.
Now, your original budget was based on 10,000 units, so if you just compare your actual costs to that original budget, it's not really a fair comparison.
Right, because you didn't produce as much as you planned.
Exactly. A flexible budget would adjust those budgeted costs to reflect what they should have been for 8,000 units. That way, you can see if your costs were higher or lower than they should have been given your actual production volume.
So it's a way to get a more accurate assessment of your performance, taking into account those fluctuations in activity.
Precisely. Now, closely related to flexible budgets is variance analysis.
Okay, variance analysis. What's that all about?
So variance analysis is basically the process of looking at those differences, those variances between your actual results and your budget or your flexible budget and trying to understand why they occurred.
Okay.
So you might have a price variance, which is the difference between what you actually paid for something and what you had budgeted to pay.
Right, like if the cost of raw materials went up unexpectedly.
Exactly.
Okay, what else?
And then you might have an efficiency variance, which is the difference between the quantity of resources you actually used and the quantity you had planned to use.
Okay, so that could be like if your workers took longer to complete a task than you had anticipated.
Precisely. Now, variance analysis can be really powerful for identifying areas where you need to make improvements. For example, if you're consistently having unfavorable labor efficiency variances, it might indicate that you need to provide additional training to your employees or streamline your production process.
Okay, so it's not just about pointing fingers. It's about using that information to identify opportunities for improvement.
Exactly. And when you connect variance analysis back to those activity-based costing concepts, it can get really granular. You can analyze variances at different levels, like per unit, per batch, or even for specific customer orders, giving you a much more detailed view of your cost performance.
This has been a really comprehensive look at budgeting. I feel like I have a much better understanding now of how it works and how it can be used to manage costs effectively.
Glad to hear that. Now let's switch gears a bit and talk about inventory costing. This is particularly important for businesses that, have a lot of inventory on hand, like retailers and manufacturers.
Right, because inventory represents a significant investment for those businesses.
It does.
And the way they account for that inventory can have a big impact on their financial statements and their profitability.
Exactly. Now, remember that matching principle we talked about earlier?
Yeah, match the revenues and expenses in the same period.
Well, that principle is key in inventory costing as well. The goal is to match the cost of the goods sold with the revenue from selling those goods in the same accounting period.
Oh, okay.
And that's where different inventory costing methods come into play.
Okay, what are some of those different methods?
Well, you have FIFO, which stands for first in, first out. This method assumes that the oldest inventory items are the first ones to be sold.
Okay.
Then you have LIFO, which stands for last in, first out. This one assumes that the newest inventory items are the first ones to be sold.
Okay, so which method a company chooses can actually affect their reported profits?
Absolutely. Especially in periods of inflation. If prices are going up, using LIFO will result in a higher cost of goods sold and therefore lower profits compared to FIFO.
Okay, and why is that?
Because with LIFO, you're assuming you're selling those newer, more expensive items first, so your cost of goods sold reflects those higher prices.
Right. And what about the weighted average method?
The weighted average method calculates an average cost for all the inventory items on hand. So every time you make a sale, you're using that average cost to determine your cost of goods sold.
Okay, so it kind of smooths out the impact of price fluctuations.
Exactly. Now, another important concept in inventory costing is conservatism.
Conservatism, okay.
This is a general accounting principle that essentially says, when in doubt, understate your assets and overstate your expenses.
Okay.
So when it comes to inventory, conservatism would lead you to choose the method that results in the lowest valuation for your inventory and the lowest profit for the current period.
Okay, so it's kind of like being cautious and not overstating your financial position.
Exactly. Now, we also have to talk about variable costing and absorption costing. These are two different ways of treating fixed manufacturing overhead costs.
Okay, tell me about them.
So under variable costing, only the variable manufacturing costs, things like direct materials, direct labor, and variable overhead are considered part of the product cost. Fixed manufacturing overhead costs, like factory rent, depreciation, and those kinds of things, are treated as period costs and are expensed in the period they're incurred, regardless of how much product you actually produce.
Okay, so it's like saying, hey, we're going to have these fixed costs no matter what, so let's just expense them as they come.
Exactly. Now, absorption costing, on the other hand, which is required by GAAP, treats all manufacturing costs, both variable and fixed, as product costs.
Okay.
So those fixed overhead costs get absorbed into the cost of your inventory, and they're not expensed until that inventory is actually sold.
Okay, so that can actually affect your reported profits, right?
It can. If you produce more than you sell in a given period, absorption costing will result in higher profits because you're deferring some of those fixed overhead costs.
Okay.
And conversely, if you sell more than you produce, absorption costing will result in lower profits.
Okay, so it's important to understand the difference between these two methods and how they can impact your financial statements.
Absolutely. Now, let's wrap up inventory costing with a quick look at different capacity levels. We have practical capacity, master budget capacity utilization, and normal capacity.
Okay, that's a lot of capacities. Break it down for me.
Sure. Practical capacity is the maximum level of output you can realistically achieve, considering things like scheduled maintenance, downtime, and those sorts of things. It's not some theoretical ideal number, it's what you can actually produce given real-world constraints.
Okay.
Master budget capacity utilization is the level of capacity you're planning to use based on your sales and production forecasts for the current budget period.
Okay.
And normal capacity is the average level of production you expect to achieve over a longer period, maybe 3 to 5 years.
Okay, so why are these different capacity levels important?
Well, they come into play when you're allocating those fixed overhead costs. If you allocate those costs based on a capacity level that's too high, you could end up undercosting your products. And if you use a capacity level that's too low, you could end up overcosting them. So it's important to choose a capacity level that's realistic and reflects your actual operating conditions.
All right, that makes sense. Now let's move on to cost behavior and analysis. I know we talked about fixed costs and variable costs earlier, but let's get a little more in-depth on how we analyze those costs.
Right. So understanding how your costs change in response to changes in your business activity is crucial for making informed decisions about things like pricing, production levels, and even whether to take on new business.
Okay, and how do we analyze those costs?
Well, we start by categorizing them. As we discussed, fixed costs stay relatively constant, regardless of your level of output.
Right. Rent is a good example of that.
Exactly.
Whether you're producing 100 units or 1,000 units, your rent's probably going to stay the same.
Right. Now, variable costs, on the other hand, change in direct proportion to your level of activity.
Okay, and what's an example of that?
So direct materials are a classic example. The more you produce, the more raw materials you're going to need, and the higher your direct material costs will be.
Okay, that makes sense.
And then, of course, you have those pesky mixed costs, which have both a fixed component and a variable component.
Okay, those sound a little trickier. How do you deal with those?
Well, there are a couple of methods for separating those mixed costs into their fixed and variable parts. One common one is the high-low method.
High-low method.
Yeah, it's pretty simple. Basically, you take the highest and lowest levels of activity you observed over a period, and then you look at the corresponding total costs at those two activity levels.
Okay.
From there, you can calculate the variable cost per unit by dividing the difference in total costs by the difference in activity levels.
All right, so once you have that variable cost per unit, how do you figure out the fixed cost component?
Well, you can use either the high or the low activity level and its corresponding total cost, and just plug those numbers into the total cost equation.
Which equation?
Total cost equals fixed cost plus variable cost per unit times activity level.
Right.
And then you can solve for the fixed cost. Now, it's important to remember that the high-low method is just an estimate. It's not going to be.